Welcome to the Deep Dive. We're taking a recent earnings call transcript, this one from a key company in semiconductors and displays, and we're really going to unpack it for you.
That's right. The goal here is pretty simple. Pull out the key numbers, the strategic thinking, and what management's saying about the future. We'll give you the important stuff.
Exactly. All the essentials without you having to read through pages and pages.
Yeah.
So let's dive right in. Fiscal second quarter 2025. What were the headlines? How'd they do?
Okay, so for Q2, total sales landed at $211 million. That was pretty much right in the middle of their guidance range. So operationally, seems like they hit their marks.
Right on target. Okay. And profitability, what did that look like?
Non-GAAP earnings per share, that came in at $0.40. And, non-GAAP just means they've adjusted things a bit, usually taking out one-offs to show that core operational profit.
Okay.
They were also pretty active buying back stock, spent $72 million in the quarter, repurchased about 3.6 million shares.
72 million, that's quite a bit. Is that it for their buyback plan for now?
No, not quite. They mentioned they still have around $23 million left under the current authorization. And cash-wise, they're looking solid. Ended the quarter with $558 million in cash and short-term investments.
Okay, so hitting guidance, buying back shares, decent cash pile. That's the quick picture. Now, let's peel back the layers. The revenue, how did that break down between their markets?
Right, so that $211 million total, it was basically flat compared to the last quarter, Q1, but down slightly, about 3% compared to the same time last year.
And the split between ICs, integrated circuits, and FPDs, the flat panel displays.
IC was the bigger piece, definitely. $156 million in revenue from ICs. That itself was down 3% year over year. And a key thing they talked about here was, the ongoing trend of design node migration. Still favorable for them.
Okay, design node migration. We hear that a lot. Remind us quickly, what does that mean for this company, and why is it a good thing for them?
Good question. So think of nodes like 5 nanometer, 28 nanometer. It's about how tiny the circuits are. Migration means chip makers are moving to smaller, newer nodes. For a photomask company, remember, they make the stencils to print these circuits. Smaller nodes mean, way more complex patterns.
Right.
This usually means more mask layers per chip, and importantly, more advanced, higher value masks. These command higher prices, better margins. So smaller nodes, more complexity, it drives demand for their high-end stuff.
Ah, okay. Smaller means more complex, which means more business, potentially higher value business. Makes sense. So within that IC revenue, where did they see the strength specifically?
Yeah, they pointed to high-end IC revenue. That actually grew 2% year over year, and it made up 38% of their total IC revenue, which is pretty significant. They called out good foundry demand in Asia, specifically for 22 and 28 nanometer masks.
Interesting. So even 228 nanometer, not the absolute cutting edge, is still driving high end for them.
Exactly. Those nodes are workhorses for tons of applications, and Asian foundries are busy there. But, the flip side, as you might expect, is the mainstream IC market. That's been tougher across the industry.
Yeah, we've been hearing that. How did mainstream look for them?
That's where the weakness really showed. Mainstream IC revenue was down more 6% year over year. Management said the biggest hit was on masks for the oldest design nodes, the really mature stuff. And that ties directly into lower wafer utilization at the fabs running those older processes.
And wafer utilization is just how busy those factories are, right? Less busy means they need fewer masks.
You got it. Yep. Lower utilization, less chip production, less demand for masks. Simple as that. But interestingly, even within mainstream, they are seeing a bit of a positive trend. Some customers are moving within mainstream to slightly more advanced, higher value mask types.
So even if it's still mainstream, they're moving up the value chain a bit within that category.
Sort of, yeah. It helps offset some of the weakness from the really old nodes because these slightly newer mainstream masks are still more complex and fetch better prices.
Interesting dynamic.
Yeah.
Okay, what about the types of chips? The applications?
Well, memory applications saw a sequential dip, but they said that was mostly just project timing with customers. Logic applications, though, were strong, especially masks for mobile communications, think Wi-Fi, Bluetooth, baseband chips, and also OLED driver ICs, stuff going into phones and gadgets that are selling well.
Right.
But on the other hand, the lower end stuff like power electronics, automotive, industrial, those sectors are still recovering more slowly. Weaker demand there.
Yeah, that pattern, software, auto, industrial, power on mature nodes, that definitely echoes what others are saying. Okay, let's pivot to the other side. Flat panel displays, FPDs. How is that market?
FPD revenue came in at $55 million for the quarter. That was down just 2% year over year. Management kind of described it as a bit slow early in the quarter, but then picking up with expected seasonal demand.
And the bright spots within FPD.
High-end mobile displays were strong, so think smartphones, tablets, and also continued demand for advanced masks driven by new display technologies. They specifically mentioned G8.6 panel size and AMOLED adoption.
Okay, G8.6 and AMOLED, break those down quickly. Why do they drive demand for advanced masks?
So G8.6 is about the size of the glass sheet they use in the factory. A bigger sheet lets you make large TV panels or monitors more efficiently. AMOLED, well, that's the display tech in most high-end phones, known for great colors and contrast, and it's moving into laptops and TVs too. Both of these need really precise high-res masks because the circuitry and pixels are so complex. So yeah, good trends for this company's advanced FPD masks.
Bigger and better screens mean more complex masks.
Got it. Any shifts in where the revenue came from geographically?
Geographically, a lot of the strength continues to come from their IC joint ventures over in China and Taiwan. Business there was healthy, they said, tied to customers expanding what they offer. The U.S. revenue, though, actually declined sequentially.
Oh, interesting. Why was that? They pointed to two things. That same weakness in the lower end, older nodes we discussed, and also just the timing of some advanced node projects with their U.S. customers.
Okay, that gives a really good sense of the revenue picture. Let's move down the income statement profitability. Gross margin was 37%. How does that compare?
Yeah, 37%. That's actually quite good for them. Management highlighted it's right around their average for the last 3 years and noticeably better than historical levels before that. They credited elevated operational controls, basically, being efficient.
So running the factories well and operating margin.
Operating margin landed at 26%. That was better than their guidance and up nicely, about 180 basis points in the previous quarter. They also noted that their joint ventures, especially China and Taiwan, contributed more to profits this quarter, which helped boost that overall operating margin.
Efficiency plus strong JV performance. Nice. All right, switching gears again, cash flow and capital spending. How did that look?
They generated $31 million in cash from operations. Management said that's about 15% of revenue, which is pretty healthy conversion. On the spending side, capital expenditures, or CAPEX, were $61 million in Q2. That includes money going into their planned U.S. expansion projects.
Right, tying into that whole semiconductor reshoring trend. What's the plan for the full year on CAPEX?
They stuck to their target of $200 million for fiscal 2025. That money's going towards a mix of things. More capacity, better capabilities probably for newer tech, and replacing old tools. They do expect CAPEX to come back down to more normal levels in fiscal 2026, so this year is a big investment push.
And that $72 million share buyback we talked about, how does it fit into their overall plan for using capital?
Management laid out 3 priorities. First, invest in their own organic growth. Second, make strategic investments if needed. And third, return cash to shareholders. The buyback falls squarely into that third bucket. They called it opportunistic, suggesting they felt the shares were good value.
Okay, makes sense. Now, beyond the pure financials, the call also hit on some important strategic points and a pretty big leadership change, right?
Absolutely. Strategically, they keep hammering home the advantage of their global footprint. They've got 11 manufacturing sites, clean rooms spread across the globe, 6 in Asia, 3 here in the U.S., 2 in Europe.
And why is being spread out like that such a big deal for them?
Well, they argue that being close to customers is crucial. It means faster response times, better collaboration on tricky designs. And now, with the whole industry trying to diversify manufacturing geographically, having that global presence is seen as a major plus for grabbing new opportunities.
Like the U.S. expansion lining up with reshoring efforts.
Yeah, exactly. Their U.S. investment is timed to support chip makers building or expanding fabs here in the U.S., aligning with those customer roadmaps.
And how does this global setup play into things like tariffs and trade tensions?
Yeah, they touched on tariffs directly, acknowledged it adds uncertainty, but they positioned their diverse footprint as a way to mitigate that risk for customers. If they can make masks in the same region where the customer's fab is, they can often avoid cross-border tariffs altogether.
Smart.
They said their analysis shows negligible impact right now, but it's clearly a strategic buffer they're leveraging against potential future costs.
Okay, that's a practical benefit.
Right.
Now, the other big news, the CEO transition.
Yes, very significant. Frankly, the CEO for the past 3 years and with the company for 20 years total announced he's decided to retire. He plans to stay on through a transition period to manage operations and will remain on the board afterwards.
And the successor.
George Morostis is taking over as CEO. He's not an outsider. He was actually the chairman of the board and has been on the board for about 20 years himself. His background includes founding Raging Wired Data Centers, which was a pretty successful player in that space.
So, a familiar face moving into the CEO role. What did he say about his focus during the transition and going forward?
George really emphasized operational execution, keeping things running smoothly. He framed the transition as an evolution, not some big shakeup. The plan seems to be a phased handover. He'll initially focus on areas like admin, governance, HR, finance, legal, and then gradually take on more of Frank's direct operational duties.
Okay.
And both Frank and George made a point of saying they share a focus on keeping costs down and really pushing for market share gains, acknowledging it's a competitive, kind of finite market at any point in time.
So, continuity, operational focus, drive for share gain, that seems to be the message around the leadership change. Let's try and tie some of these details back to the bigger picture industry trends they discussed.
For sure. The call definitely underscored that ongoing weakness in the mainstream market. They repeated it's tied to low utilization at older fabs, hitting demand for parts and power, industrial, older consumer stuff. And for mainstream masks themselves, the supply-demand balance is tricky. Old tools are retiring, but new capacity is also being added elsewhere while demand stays soft. It makes for a tough environment there.
And their forecast for when mainstream might actually pick up significantly.
Yeah, this was important. Based on what they're hearing from customers about fab usage, they said they don't see a strong recovery in mainstream volumes happening until maybe even late in calendar year 2026.
Late 2026. Wow, that's further out than maybe some were hoping.
It is definitely a cautious take.
Was there any positive note or potential bright spot mentioned for mainstream?
Yes, actually. One interesting point tied back to that regionalization trend. They noted some high-end chip makers, as they set up shop in new regions, might start outsourcing the less complex mask layers needed even for their advanced chips. 5-nanometer chips still need some layers that are more mainstream-like in complexity.
Okay.
So as these advanced players build regionally, they might hand off those simpler layers to companies like this one with a strong local presence. It could create some new, maybe unexpected demand within their mainstream business.
So advanced chip moves could actually trickle down some benefit to the mainstream side eventually.
Interesting. Okay, pulling it all together, high-end strength, mainstream weakness persisting, big investments, leadership change. What was the overall tone for the near term?
Definitely cautious. They explicitly linked it to the market conditions, essentially that mainstream lag, plus the broader economic uncertainty, tariffs included.
And the specific numbers they guided for Q3.
For the third quarter, they're guiding revenue between $200 million and $228 million. Non-GAAP earnings per share estimated between $0.35 and 41 cents. And that EPS range implies an operating margin somewhere between 20% and 22%. They also reminded everyone that their visibility isn't huge. Their backlog is typically short, maybe 1 to 3 weeks. And single big high-end orders can really swing the numbers because of the high prices. Ultimately, their business follows the pace of new chip and display designs coming from customers. So, bringing this back to you, the listener, understanding these specifics, the contrast between high-end and mainstream, their global strategy, the margin drivers, the leadership plan, the cautious guidance, it really helps paint a picture of the broader photomask market right now, doesn't it?
Yeah, it shows a segment with real pockets of growth tied to cutting-edge tech, but also this persistent drag from the more mature parts of the market. And that caution tells you a lot about the current macro environment they're dealing with, especially around those older nodes and global jitters.
All right, let's move to our not financial advice segment. We always say this, but it bears repeating. This is purely a thought exercise based only on what we heard in this earnings call transcript. Do not take this as a recommendation to do anything in the market. It's just kicking around an idea.
Exactly. Totally hypothetical. We take something specific management said and spin out an outrageous but plausible trade concept. So given that very specific commentary about mainstream weakness potentially dragging on until late 2026 and calling out soft spots like automotive and industrial.
Right, sectors heavily reliant on those older nodes.
One could hypothetically construct a very targeted bet. Maybe it involves short positions, maybe aggressive put options, focused on companies in the wider semi ecosystem that, are overly exposed to those specific older nodes and end markets, the ones this company said are recovering slowly.
So the bet isn't just mainstream is weak. It's management's timeline for that weakness extending to late 2026 is accurate, causing more pain for those less diversified players.
Precisely. You'd essentially be shorting the duration of the mainstream slump in those specific identified weak areas. And maybe, to make it plausible, You pair that short side with a long position, maybe calls on companies benefiting from the trends management did highlight as strengths like G8.6 display makers or advanced node leaders who might do that regional outsourcing of mainstream layers we talked about.
The outrageous part is the laser focus, the potential leverage, and betting heavily on one company's timeline for a specific segment. But it is grounded entirely in the call's details.
A transcript-driven thought experiment, nothing more.
Okay, so wrapping up the key takeaways. This company managed a mixed Q2, hit their numbers despite mainstream softness, leveraging operational strength.
Their global footprint is clearly a strategic plus for customer proximity and navigating trade issues. And the leadership transition seems focused on execution and gaining share.
But they are cautious near term due to market conditions and macro factors. Still, they see long-term opportunities in high-end node migration, advanced displays like G8.6 and AMOLED, and maybe even new mainstream dynamics from regionalization.
And remember, everything we discussed today came straight from the source material, that earnings call transcript.
So a final thought for you to mull over. They're cautious now because of macro uncertainty, but they're making these big long-term strategic bets on node migration, G8.6, US reshoring. How might a sudden unexpected shift in the global economy, maybe a sharp upturn or downturn or a major geopolitical event, disproportionately affect them? Could it supercharge the upside from their investments or amplify the downside risk from that market softness they're navigating? It really underscores how sensitive their path forward is to those big external factors.